After the housing crisis in 2008, financial institutions and investors lost a lot of money on mortgage-backed securities. The Truth in Lending Act, TILA, was amended to add a new category of mortgage, the qualified mortgage or QM. This new category is considered a low-risk mortgage and must have all three characteristics in order to be considered a qualified mortgage. 1. The mortgage must not have a risky feature such as interest-only, negative amortization, or a balloon, with one exception for small creditors. 2. The loan term must not exceed 30 years. Lastly, the points and fees charged by the creditor must not exceed 3%, generally, with higher percentages allowed for smaller loan amounts. If the mortgage does not have all three characteristics, it cannot be considered a qualified mortgage. Instead, it is a non-QM. If the creditor chooses to do qualified mortgages, the creditor is presumed to comply with the other half of the Truth in Lending Act amendment. ATR, or the ability to repay. The ability to repay rule requires creditors to verify consumers have the ability to repay any consumer credit transaction secured by a dwelling, with the exception of home equity lines of credit, timeshares, reverse mortgages, and temporary loans. Creditors must verify the consumer's ability to repay using, at minimum, 8 underwriting factors. DTI, debt-to-income ratio, or residual income, credit history, housing obligations such as property taxes and insurance premiums, other debt obligations such as auto loans and credit cards, the mortgage payment itself, current or reasonably expected income or assets, the consumer's employment status if using employment income, and any other loans closing simultaneously. You can remember this with the acronym DC Homies. Qualified mortgages that are not considered a higher-priced mortgage loan in seasoned QMs are presumed to comply with the ability to repay requirements of TILA. This concept is known as having a safe harbor. Instead of a ship being safe in a harbor during a storm, the creditor is safe from proving that the ATR was verified as required in a foreclosure proceeding, since QMs are low-risk mortgage loans. If a QM is also a higher-priced mortgage loan as defined by TILA, the creditor is still presumed to comply with the ability to repay requirements. However, the borrower may challenge this in a foreclosure proceeding, or rebut the presumption, and provide proof there was not enough income to support the new mortgage and other monthly recurring debt.